Go. Okay. Hello, everyone. Welcome to another week of Learn It Live. It's been a few weeks since we were here last, so I'd just like to say hello, Ty.
Hey everyone, how you going?
From another location today.
Yes, we are. We're doing multi-level conducting tonight, so bear with us, but it should be all good.
Yeah, it's going to be a good one. So today we're talking about something that I don't think I've seen that often when it comes to these webinars, but I think it's important for us to have as many tools in our arsenal as possible when it comes to trading. So we'll get started, and obviously today is how to trade different asset classes. So as always, we've got the risk warning. This information here has been produced by third parties and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. So what we'll be covering today, we're going to cover and understand how different asset classes move and are constructed. So each asset class has a little bit of kind of like each currency has a little bit of a flair or a different way that we can trade it, and we need to understand the differences between each asset class. So we'll talk about that. We'll also look at asset classes that are potentially best for you and which ones are best to start trading with. And then we'll talk about some facts you don't know about the index markets in particular, because I think index markets are something that a lot of people don't understand, but they're becoming incredibly popular. I know that a lot of people I've spoken to over the last couple of years, they're looking at index markets as something that they diversify and invest into. And as always, if you have questions, we'll answer them at the end of the webinar. So please ask them throughout the webinar, and Xavier will get back over them, and then we'll answer them at the end. So let's get started with the one that we all know and we probably all trade, and that's currency. So with currency, a lot of people don't understand what the majors are or even which currencies to start with. So I get asked this a lot, and I know Tyron does as well. A lot of people say, oh, I trade the ZAR, or I trade the SGD, and I trade all these other pairs, but they don't really look at the majors, and they don't really think about, okay, I'm going to start trading, and maybe I'm going to become a specialist at certain currency pairs. So we often suggest to students, and we often suggest to people that are starting, stick to the majors. And the majors are really anything like the Euro US dollar, Pound US dollar, US dollar yen, or US dollar, any of the top 8. You can actually just search in Wikipedia the major currencies of the world, and you'll see straight away the majors. And if you start with them, then you have a really good base, I guess, in terms of the currencies that you'll learn, and you'll learn how they're traded, and you'll generally have the best technical analysis signals on these as well, because they are the most liquid currencies. So Ty, what do you want to know about liquidity?
Yeah, well, the thing is, when you're always watching the majors, you do become familiar with them. So we always encourage our students to really start with probably 4 or 6 as a bit of a basket for the currencies, because when you do realize, that they're moving in a certain, I guess, volume each day. Like say, for instance, if we were looking at the Euro USD, if it was moving, say, 50 to 100 pips a day, we would consider that very normal. But if you look at the chart and it's moved maybe 200 pips, straight away you'll realize that that's actually an unusual move, and you'll start to look for the trades that you're looking at will be just seen in a different light. Whereas when you're trading the more exotic currency pairs and you don't fully understand how much they can move in a day, 200 pips for some pairs is actually a very, very normal move. And you might look at it and say, wow, that was a big move, we must be really trending, when in fact, a 200 pip move is just average. Whereas a 200 pip move in a day for the Euro or even the Pound USD or the Aussie USD is actually a significant move. So it can actually signal that the trend could be about to break, or it could just have launched out of a support or resistance zone. But yeah, knowing that you're only doing a certain amount of currency pairs, you get very familiar with what their movements are each particular day, and also where their levels are, so you can identify them very quickly.
And I think it's also, it kind of comes back to that blue chip idea. When you hear stock trading, people always say blue chip stocks, the ANZ, CBA, the Australian banks, by the way, BHP, those kind of things. And in currency, it's like the blue chip currencies. We want to start with the blue chips because they're the ones that have the high liquidity. They're the ones that are technically traded. and they're also less susceptible to fundamentals really jumping in and making a massive change to those currencies over days. So as Tyron said, 100, 150 pip daily candle is quite large on the euro or pound US dollar versus, something like the Mexican peso, which when Trump was being elected was moving very quickly. And they can be a bit more dangerous and not consistent with the types of trades that we'd like to take if we're treating our trading like a business. So the next thing I want to bring up was the importance of central banks in currency movements. So whenever we're diversifying, especially even through the majors, we need to be very aware that we're usually trading against the US dollar, and therefore we need to be aware of what the central bank is doing or the Fed's doing in the US. So you always want to stay on top of that. You want to look at non-farm payrolls. That's the main kind of, fundamental data that you always want to look at. We'll talk about it. But you don't usually want to trade it. You just want to be aware of what they're doing with interest rates and what they're doing with monetary policy, because that can be very important to the longer term trends in the markets. Then we also want to talk about technical analysis. So I think technical analysis works incredibly well in the majors. I don't think it works as well in some of the massive cross currencies because they're more susceptible to just one-off kind of news events and other things. But technicals have a place in every currency, but specifically the majors, very, very good. And generally when we're trading currencies, we're really looking at shorter time frame trades. So a lot of people scalp currencies and a lot of people trade them maybe intraday. And I do find that currencies are excellent for this kind of process because of the way we have margin and because of the moves that we're looking for and the cost of entry. But if you're looking at something like an index, indexes might be more of a weekly to monthly kind of trade. Like you might hold an index for a couple of weeks, you might even hold it for a couple of months or years. And we'll talk about some of that soon. So generally shorter time frame trades, if you're looking at scalping, currency is definitely the place to be because you don't have to hold the currencies a very long period of time. Ty, do you have anything else to say about that?
Yeah, the great thing about technical analysis, like Thomas touched on, was that it does work extremely well on the majors and on the indexes, mainly because there's just a lot more people looking at it. So yeah, technical analysis is based on the fact that history will repeat itself. And the more people that are seeing that, the greater chance there is obviously of patterns playing out or or anything really indicators actually working out where people are trading a particular direction or waiting for a particular cross. Then, of course, we've got to remember that a lot of the cross pairs are driven by what the majors are doing. So it's a little bit like knowing what the central bank's doing. When you do know what the majors are doing, it gives you a bit of an insight on to what the cross pairs will be doing if and when you start to look at them. But definitely, if you're beginning your trading journey and you're just starting to get your way around the platforms, try to stick to the majors and some of the bigger indexes, and we'll tell you why the indexes are really good to trade throughout this webinar, but you can't go too far wrong if you actually mix your basket a little bit like that.
Yes, yeah, that's very true. So a couple of things, just when you're in the MetaTrader 4 platform, if that is what you're using, you'll notice usually when you load up the first time, you've kind of got these grayed out symbols. Generally, most of these top ones, at least they're the majors. The pound yen, also known as the beast, does have big movements. That has become incredibly popular actually to trade over the last couple of years. Specifically, these ones up here are a good place to start. So a lot of people ask this question, definitely a great place to start with these pairs up at the top. And I think the other pair that's probably worthwhile looking at is going to be gold as well, which we'll talk about in commodities. So let's just jump straight back into the slides, talk about commodities a little bit, and then we'll talk about indexes, and then we'll jump into the charts for each one and talk about a couple of, indicators and things that we use when we're talking about diversification for these. So with commodities, they're based on a fixed parcel or size of a certain material and its value versus the currency. Now, it's really important that we understand that it is based on a certain size or parcel, because when people start trading things like silver versus or gold, they'll start with maybe making the mistake of trading a single contract. So a single contract of gold is not a single contract of currency. It is quite different. So if anyone's ever made that mistake and they've said buy one contract of gold, you may end up having a higher charge or higher movement cost than you think, because basically a single If gold moves $1, I think it's going to be $100 in your, of gain or loss in your account. The same goes for silver. The parcel size for silver is very large. So when you trade a single, it turns out to be a lot bigger than you think. And that can be quite painful. I have had a lot of students in the past accidentally click on silver, not reading the right code, and they've clicked it and made that mistake. I think we've all probably done that.
If you have done that, you have got plenty of friends, because nearly every trader that we work with has done that at some point. It's just no question. It is a very, very easy mistake to make, especially when you first start out. So just be very, very mindful, because it can be a costly error, especially if you enter at the wrong time.
And just remember, if you talk to somebody, one of your sales reps at Pepperstone, or trading reps, those guys will know, and they'll be able to figure it out for you if you've got any questions. So if you're looking at something like coffee, or you're looking at a different kind of soft commodity or hard commodity you've never traded before, always ask the question before you trade it, because I've been stung many times trading commodities on different platforms where the currency or the parcel size is slightly different. So definitely recommended, always check that out.
For sure. And don't forget that you can also use the smart tools that will actually also help you break it down. So if you put your right risk management in place on the smart tools window, that'll basically do the right contract size for you. So it is a really good idea, especially when you're starting out, to use that smart tools app, because it will always get you in at the right size.
Yeah, definitely. And I think the other thing about commodities is that it's going to be one where you're looking at something that can be actually diversified different to currency. So one thing that often people say is that gold goes up when there's uncertainty or something wrong going on, either financially or maybe even war or something like that, tensions in the world. Gold often reacts to the positive side, and so did oil or crude oil back in many years ago. So that's often a hedge to some people's portfolios, to some people's investments. So that's why it's always worthwhile having the ability to trade gold, the ability to trade oil, things like that, or even other commodities in your trading repertoire, because once you learn these particular currencies, these particular pairs, you'll be able to maybe take advantage of such situations. I remember only a few years ago, got oil for us was massive. I mean, we were looking at oil, it was under $30 a barrel. Some people probably remember that. It wasn't even that long ago, now it's 75 or 70 again. So when those kind of opportunities come up, you want to be aware of how big the contract size is. You want to be aware of where it historically has been, and potentially look at technical reasons or fundamental reasons, maybe for trades in these particular pairs. So yeah, very much worthwhile looking at commodities. Now, the one thing I will state is that often these will move heavily off fundamental decisions. So if something does happen, like I said, war tensions or something financially is going wrong, maybe in a different area of the world, they can move incredibly quickly. So always go back over a weekly or a monthly chart, and I think that's a good thing for you guys to do, and just have a look at how these currencies or how these commodities or indexes move, and what is the average move of these, because you want to be very aware of what you're getting into before you place it. You don't want to just be on a 5-minute or 15-minute chart and looking at the last maybe only a couple of days of movement. You want to look at months, if not years, to see what can happen, so you're always prepared for those situations.
That's right. And the one thing you do have to be mindful of, especially when you're trading gold and oil, is the weekend trading gap. So when, especially if there's an important meeting, there could be a G20 summit they're generally done on a Saturday or a Sunday, or there could be an OPEC meeting, which is very, very particular to oil. They can have very, very big moves from the Saturday early morning close of New York to the Monday by the time we open in New Zealand and Australia. So you've got to remember the stop losses will get jumped if there is a gap. So you have to be very, very careful when you are trading those commodities over the weekend, especially if your contract sizes on the riskier side. So just be very, very mindful of any news that's going to be released. For those of you who don't know, you can find out anything you want about what news is going to be released on the weekend from sites like Forex Factory, who has the updated calendar there that you can see at any time when a news event is going to be, literally to the minute. So not only does it give you the time that the news release is going to happen, but it also gives you the expected outcome of what that report might be, or what the general consensus is going to be. So if there is a surprise in the market, quite often it will be picked inside of the Forex Factory forums. So definitely take a look at that if you haven't checked it out.
And now I think we're going to come on to one of our favorites, or at least Tyron and my favorites, and that's index markets. So a lot of people don't really understand indexes, which I think is really interesting. So one thing is about indexes is that, let me just get rid of this, is that they are made up of usually quite a few different underlying stocks or companies. So say you have the ASX 200, and that's in Australia, that's the Australian stock market. That's actually the top 200 stocks in Australia by market cap size, so by how large they are. And it's all portioned out to a percentage for each particular stock. So in Australia, the biggest stock or the biggest company is Commonwealth Bank. It used to be BHP, but now it's Commonwealth Bank. So when you buy the ASX 200 index, you're actually technically purchasing a percentage of Commonwealth Bank, a percentage of BHP, a percentage of any stock that's in the top 200 by the size of that company. And that's something that's really good because it gives you the diversification. I think today is a lot about diversification of all of the different things that make up that index. So you're going to own some financials, you're going to own some materials, some energy sector, you're going to own IT, all sorts of different areas. And that means that you're really putting all of your eggs spread across baskets rather than in just one thing. And that's very powerful, and that's why you've seen this movement towards indexes over the last couple of years, where you've seen people say, well, I'm not maybe the best at picking any particular stock, so why not trade the indexes? And the best thing is that Pepperstone has obviously a lot of these major indexes around the world. So they've got things like the S&P 500, which is the top 500 stocks in America. They've got the NASDAQ, which is obviously the top tech stocks in America. And usually the number after it will be how many companies are in that. So obviously the Dow Jones, which is the oldest one, that is how many, Ty?
Dow Jones is 30. It's 30 of the most significant stocks in the New York Stock Exchange. So, and the Dow Jones is a little bit different to the others because it's a price weighted average. So, but it is based only on the most significant 30 stocks. And stocks do drop in and out of that as their, I guess, significance rises and falls inside that country. And it is a big deal when something falls out of the top 30 in the Dow Jones. But in a way, a lot of the world is driven by what the Dow Jones index is doing. So when you're watching TV in the morning and the news reports come on, they talk about what the Dow did overnight, or how much it moved. But in reality, the Dow's only measuring the movements of 30 companies, whereas the S&P 500 is actually the top 500 companies in America. So in a lot of ways, that's probably the most significant index in the world, or especially the most relevant to us, because we do seem to mimic a lot of what the US does, and we are driven, even if we've got good news in our country, if the Dow Jones and the S&P 500 are falling in a particular direction, quite often we will follow. So they do tend to overrun.
And I think that's one thing that Ty's brought up. Then the US 30 and the S&P 500 tend to run our markets a little bit. I don't know if anyone out there knows, but obviously the Shanghai index is getting beaten around a little bit at the moment in terms of being sold off, and that's the massive Chinese market index. And we're not really, the Australian market's not really moving down. In fact, it's going up and making greater strengths and new highs. So we are still really quite dictated to by the US. If the US fell off 3% tonight, we would open lower tomorrow. That is for sure, pretty much. So and one thing about
it would be irrelevant of any of our news as well. So and that's the thing. And as much as technical analysis is important for our index, it is vitally important to actually do technical analysis on the S&P 500, because if you can get that movement right, a lot of the other indexes will follow.
Yeah, so one thing about these indices, and a lot of people probably don't get it, and I'll go on to point 4, is how does the rebalancing of these work? So basically every period of time, and it does differ from index to index, and you should do research on that, they will make a decision, usually potentially once every quarter, and the S&P or somebody else will come out and they'll basically say, okay, this company was this large last time it was there, but now this other company is bigger than it, and then they do the weighted average, and one effectively company could get kicked out and another one replaces it. So it's still always, in the case of the S&P 500, it's still always be 500 top stocks, but it doesn't mean that you always own that particular stock. And if you're an Australian, one company always comes to mind, I always tell people this, is Billabong. Billabong was huge, massive surf brand, everyone was wearing it, probably a lot of you guys are aware of that clothing company. And what happened was they were a top 50 stock at one point. Now they're definitely not. They're not even a top 300 or anything near that kind of size. But at one point they were in the top 200. Now they're not. The point is that it went up, and then obviously it slowly went down. It got kicked out and replaced by hopefully a growing company. So the great thing about indexes is they kind of do the kicking of a bad egg for you. It kicks it out, brings in a new one. And what we know is that generally quality lasts, and therefore your investment or these indexes are usually something that goes up over time. So I'll give you some stats later, but they are something that goes up over time.
We actually learned a very valuable lesson in that regard, because FX Evolution is actually in charge of a managed fund where we're mandated to hold only 200, the top 200 stocks. So we had basically some technical analysis on a company which I'm not going to name because it hurts me, but it was about 198 when we actually put it into the fund. So everybody that entered that stock got it actually at a very, very cheap rate. But while we were holding it, it actually its market cap dropped, and it actually got kicked out of the top 200 and went to about 201 or 202. But unfortunately, that meant that we had to actually exit all of our positions from that particular stock, and basically had to replace it with something else that was inside the top 200. Literally, probably a week and a half to 2 weeks later, it had a takeover bid and tripled in value. So, yeah, just by the fact that we had to only use stocks that were in the top 200, we had to actually exit all positions, even though they weren't actually down. And yeah, literally only a week and a half later, it had a takeover bid and it tripled in value. So yeah, you can it was painful.
The ASX 200 came back in.
And that was only the ASX 200. So that's the significance of it.
Yeah. So look, that's something though very, very important. So when it comes to rebalancing, it does it for you. It does that diversification for you. Now, it's important the movements can be slower and more prolonged trends. So we're going to take a look at that in the charts in a minute, and you're going to see what I mean. But that's very, very important. And the last one is dividends and earnings. So we'll talk about that in the charts as well. But it is important to understand that when you own an index, technically all of the companies underneath it may pay some form of income or dividend, which you may have heard of, and we'll talk about how that works with swap. So let's jump straight back into the charts, and I've got up here the US 500, and what I wanted to do is I just wanted to put it on a weekly for everybody to really see what's happened to the US 500 over, I guess, the last decade. So we can see here, this is actually the GFC. So this is the 2007 highs, and this is the low of the GFC. And then we can see where the market is right now, which is incredibly high considering where the GFC was in the pullback. But what I really wanted to more point out is you can see here, we've got weekly, we've got MACD completely set to the standard settings. And look at what happens every time the MACD crosses to the upside. Often it goes on a prolonged multi-week / month move to the upside. And that happens almost every time it crosses. And you will notice with all indexes is because the companies underneath it are growing with inflation and with everything in the financial system, generally like housing, this particular type of investment is always more, I guess, prolonged to go, or more likely to go up than it is to go down long term. So the actual growth of an index, most indexes in the major countries around the world, if you averaged it out over the years, it's around 7.5 to 8, which is almost exactly the same as housing throughout most of the westernized countries. So a lot of people, don't realize how powerful these indexes are as an investment tool. They really have done incredibly well long term, just like I guess traditional housing.
But unlike traditional housing, you can exit and enter positions very, very easily without the big fees that are associated with
Correct.
trying to sell a house. So there is a very, very big push for these
No
types
annoying
of
tenants.
investments, and no tenants, and no
Yeah.
and no breakdowns. So it's a
Yeah.
very, very good tool for diversification, because it does give you a very, very broad ownership, if you like, of what is happening in basically a country's economy.
Yes, and they've become incredibly popular for that reason. So what I wanted to just talk about is the fact that when we are trading these pairs, we need to be aware of the potential costs that could be incurred, and we also need to be aware of the fact that we're going to need to be in these trades for a longer period of time. So when we're placing, let's say, a US 500 trade, we may not necessarily want to be in it just for intraday. We may want to say, look at the chart like this and say, okay, this is broken to a higher upside. And when that break has happened, we may want to be in this for potentially weeks, if not months, but the rewards can be significant. So definitely something I always look at and are very popular.
Sure. I've actually just seen a question from Martin about the MACD. Apparently he can't see the MACD on the screen. For anybody else who can't see the MACD on the screen, this is just a standard MACD of the 12, 26, and 9. And quite often, even when we are moving between currency pairs and indices, or even stock for that matter, we actually don't change the general settings of the MACD. So if you can't actually see the settings on it, or if it is too small, it is the traditional 12, 26, and 9 settings of a normal MACD. So what's basically the default on the MT4 indicators?
One other thing about these indexes is they are spot indexes and they are the futures effectively. So they will trade while the market is closed. And just be aware of that. So if you're trading something like the US 500, it is going to be moving mostly when the US market opens, and that's when you're going to see the biggest moves, and you're also going to see usually the lowest spreads. So US 500, it'd be something like maybe 10:30 at night for Australians would be a time when you would start to see the spreads come in and it to be a cheaper trade. And the ASX 200, it would be around 10 o'clock in the morning when our market opens. So you need to be aware of these things and always do research before you do trade these pairs. But once you've done the research and you start to learn them, you'll have a lot of fun with them and hopefully be quite profitable.
Just like with the commodities that we were talking about earlier, like gold and silver and oil, the contract sizes do vary for the particular indexes as well. So when you're looking at the indices, just be mindful that one contract or 10 contracts is very, very different to currency. So again, use the calculator that you've got in the Smart Tools, and yeah, that'll put you in the right direction, because you can trade it in the same way and risk the right amount still, and then it will work out the correct contract size for you.
So I just wanted to load up this quickly. It was a slide that we took from, I think, our last Learn It Live, just MACD, moving average, convergence, divergence. As I said, very, very good for use in stock markets. That's because realistically, a lot of these indicators and a lot of tools that we use were derived from the Dow and therefore are now used in the S&P 500 and used in other indexes. So this particular, or MACD strategy is very common to be used. I know a lot of the big traders, people like Goldman Sachs, JP Morgan, those kind of guys, they do use the standard MACD. You don't need to get funny or fancy with it. You just use the normal MACD the way that you have been using it in the currency charts, and it should be quite successful. So here we've just lined up all of the times that it crossed from the negative to the positive or the positive to the negative, and you can see the movements here on this particular currency. But in the stock market or the indexes, when these moves happen, specifically on the bigger time frames, they're often prolonged, especially the buy side ones, and you can get involved and they will usually move for a longer period of time.
Yeah, and that makes sense. So when we look at the S&P 500, for instance, like it only crossed down to the negative MACD cycle, 2 or 3 times in the last, 7 or 8 years. And it makes sense when you think about it, because if we're looking at a weekly chart, the 12 and the 26 moving averages, which is what's basically driving the histogram, have to be above or below each other for a certain period. So every time that the MACD histogram goes below 0, that's indicating that the 12 moving average is below the 26 moving average. Now, if we're on a weekly chart, it stands to reason that for a 12 moving average to be below the 26, we're going to have several weeks of actually downside movement. So it takes a lot to actually drop the histogram to below 0, because it would require several weeks of weakness in that particular index. And the thing with the indices are that they're not easily manipulatable. So, good luck trying to manipulate the 500 biggest stocks in the US. So you might have a couple of down nights in a row, or even maybe a week of down movements, but very rarely does that affect the moving average. So that's why in all of this time, in a very, very strong uptrend, it's been very, very rare for the MACD to drop below the 0 line. And every time it has been a reasonably significant pullback. And when it has come back up, like Thomas alluded to, it has been quite a violent reversal.
Yeah, it's definitely moved with quite a lot of pace. And of course, in a bullish market or bullish economy, like we've been seeing for the last, I guess, decade since the GFC, when the movements go to the upside, they're often aggressive. The pullbacks can sometimes be quite aggressive, but then they V-shape reverse. So like we see here, the pullbacks happened. I'll just zoom in on it so everyone can see it. So the pullback has happened multiple times. It's quite aggressive, and you get quite a few days of pretty major sell-offs, but then that buy side comes back in. And when that does come back in, often it makes new highs. And that's just because when we think about it, the companies underneath it employ people to make more money for them effectively, or to do good business. And when they make more money, their market capitalization should go up because their valuation goes up, and therefore the top 500 stocks should all be going up accordingly, and that will mean that the growth of this particular index is there. So indexes are really, really, really interesting to learn about. Definitely opened my eyes to a lot of extra opportunities. I think it should be part of your trading arsenal. So when we're looking at, even if you just want to stick to some of the more basic commodities, we should always have our major currencies. We should check them regularly. We should check our major indexes, because there can be some great longer term and even short term opportunities there. And we should also check our main commodities, things like oil, things like gold, possibly silver. Some of the soft commodities, they're a bit more reliant on maybe weather. So if you're getting into things like orange juice or cotton or wheat or anything like that, you do need to be aware that they're not always open markets. And if something does happen, let's say there's a tornado or a hurricane or something like that, and those crops are affected, they can move very violently. So they're cool if you want to bring them in, but I would suggest that if we stick to the blue chip things like the indexes, the main commodities, at least initially, and the main currencies, if we can be successful there, then we can spread our wings and go to other things. But at the start, if we stick to these major indexes and commodities and currencies, we do quite well.
The thing we get asked a lot of is that if you're only looking at 6 or 8 pairs or trading instruments, and you combine those with indices and you combine those with some commodities, are you going to get enough trading opportunities? But what you do have to be mindful of is that although you might only be looking at, say, a basket of 6 currency pairs, you do have the opportunity to break them down to a daily, to a 4-hour, and an hour, and even a 15-minute chart if you want to go that low. So one currency pair might require 4 different analysis charts to actually work out what is going on with it, and with every different time frame comes a different trading opportunity. And that goes for the indices and gold, silver, and oil. So anything you choose to trade, really. So even if you were looking at, say, maybe 10 in total of basically indices, currency pairs, and some commodities, you might have to actually analyze 40 charts just to get the real picture of what's going on. So, and that's a pretty significant, amount of charts to look at. I mean, I don't think I even look at 40 charts in a week. So it's really, really important to hone in on what you understand and what you think works for your trading style, because all of these instruments do have different trading style. So one, you can identify when when there is a change that is away from the norm is happening, so you can be aware of that and not trade against it or potentially trade with it. But probably just as importantly, have a feel for what you expect that currency pair to do, because that really makes a difference when you're setting your take profit and your stop loss levels, because you have an expectation of what is normal for that currency pair or trading instrument.
Yes, yeah, definitely. I think having expectations there is very good. So if you're somebody that wants to hold positions for a longer period of time, indexes is going to be a great place for you to start. If you're somebody that wants to get, I guess, down and dirty with it and trade intraday and not hold the position too long, then often you'll want to do currencies, and potentially you can do some commodities as well on the shorter periods of time. But you always need to think, I want to be a specialist at certain things. Just like we specialize in our jobs, we specialize at certain indexes, specialize in certain currencies and commodities, and usually we'll be better at those particular things, and then we can go to the next ones. All right. Well, I think I'll go into some questions in a second, but I just want to go over what we always talk about, which is building a strategy and creating a business plan for your diversification into different asset classes and trading instruments. So we always want to create a business plan for every type of instrument that we're trading. What that may be will be up to you a little bit, but it's definitely very important. And we want to use consistency when you're trading a system. So once you've decided, okay, I'm going to trade indexes based on a daily, weekly, or daily, weekly 4-hour strategy, generally that strategy will force me to be in trades for maybe a week and a half. If you're taking out your trades before they hit profit within 2 days because you can't handle being in those trades, well, that might not be the best for you. That may not be the business strategy that's going to work well for you long term. So just always think about those things.
The other thing you've got to be mindful of.
Yep.
Oh, sorry. I was just going to touch on when you are trading indices. Quite often you are in the trade for longer than a currency pair, so you might be in for several weeks. The one thing you do have to be mindful of, especially around reporting seasons, is that when you do buy an indice, you are actually subjected to receiving the dividends when you're in a long position and actually paying the dividends when they're in a short position. And that happens automatically, but you do have to be mindful of if you're stuck in a trade for weeks and you see money coming into your account or going out of your account. Quite often that is in the reporting season where they do get adjusted basically every day.
Yeah, that's right. So one thing with creating a business strategy, obviously we use the Pressix system, which is something we've created over at fxevolution.com. But basically it uses what a lot of people should be doing. It creates a story for why we should be into any trade, whether it be indices, commodities, or currencies. So we should be using price action to show us the direction that we want to be placed in those trades. Obviously, risk management is incredibly important. Then there's the ELD system, which is based on different timeframes and multi-time frame analysis, which is always important to create that case. Chart patterns, some indicators, specific ones are worthwhile using, and then of course our charting techniques. And when we use all of those things together, we're basically creating a story that's compelling for us to be able to place those trades. Because as we always say, if you're risking 1% on a $1,000 account or 2%, that may only be $10 to $20. But think about you have always $1 million account. So that $10 to $20 is $10,000 to $20,000 per trade. Would you trade the same way? If the answer is no, then you're definitely doing something wrong with your trading systems. And as we always say as well, do not basket trade. So if you're trading the US 500 to the buy side, probably don't be trading the Dow to the buy side as well. They will usually move fairly similarly, and always follow your built-in strategy. So do we have any questions in the chat, Xavier? Do we have anything out there that people have asked that we can answer today about different trading instruments?
Yeah, welcoming more questions now, guys, but we did have one. So this one's from Dusan. It's a bit of a challenging one, but how do you guys find the reasons of why an index or gold is moving in a particular direction?
Yeah, so I think probably the best answer to that is to watch Feud Other Learned Lives, which you might be able to get access to. I think Pepperstone has an archive of them. So we do talk about specifically how to get into trending markets and how to make those decisions. But what you're really looking for is, like anything, we're looking for breaks of key support and resistance areas. So to give you an example, here we have the pound US dollar. What we have here is on a larger time frame, we've got a giant double top where the market's gone up, it's been in the bull trend, it's tried to make a new high and it's failed to do so, and then it's broken what we call the intervening trough here. And when it breaks that basically what it's saying is that it should go around the distance of this double top again. And then you'll see generally the market will do something like that, which it's done here, and then it will find some form of support. So learning about patterns, learning about price action, following maybe the Learn It Live series that we do, fxevolution.com, where we teach people how to do this stuff. These are the kind of things that you'll want to learn. And when you see breaks like this, you can see how aggressive the market can move. So here we have the break of the double top. This is the confirmation close candle. When that does happen, it aggressively sells off pretty much every day after until it hits where we expect, or the expected take profit zone is. So learn these things and you will start to recognize these breaks and these opportunities. And this goes to commodities, indexes, sort of thing.
Exactly right. The same patterns will work no differently than they do in the pound USD as they would on the S&P 500. So if this pattern appeared on the S&P 500 or the Dow Jones, or even gold for that matter, we would trade it in the identical way, because it's all about the movement and we're looking for the exact same thing. So that's the great thing about technical analysis, is that the learning curve is not as steep as it can be, because the same principles and techniques can be applied to every commodity and index and trading instrument there is really that has a candle that's forming, because we're always looking for that trend or a break of.
And what I wanted to say is just on that exactly. This is the US 500, S&P 500 highs. This is what happened. It formed a high, it sold off, quickly reversed it, formed a similar high, came down, broke through, and you can see the rest is history. So this was literally a double top on the US 500 before the GFC. It happened. So great pattern.
It broke down, came back, retested the neckline, and then really sold off. It was actually technical perfection. Although many bankers wouldn't have thought so.
No, I don't think many people would have thought so, especially mums and dads and bankers. Yeah. Any other questions in the webinar today?
Yeah, I actually had one. You guys were mentioning how fundamental news affected indices and your commodities a little bit more. How important do you think it is to look at economic calendars as well as technicals when trading commodities and indices? Do you guys look at that type of thing all the time when making sort of trades based on technicals?
I think it's important to understand things like seasonals and earnings reports, as Tyron alluded to. So if you understand when dividends are being paid in the indexes and when earnings are out and coming out, often that can be even more important than some of the fundamental news. The thing about indexes in particular is they're really based on how well the companies that make up those indexes doing. So if you see something like, let's say the Australian government says, we're going to build a massive railroad and we're going to build this and we're going to build all this stuff, and they're going to fund it from the government, who's going to do well out of that? Well, you're going to see all the infrastructure companies do well out of that, potentially importers doing well out of that, steel manufacturers, financial companies lending to these companies, lending to the government, all these types of things. And that's going to stimulate growth within that country's index. So that larger way of thinking about things, absolutely very, very important to understand. And this goes for
on the flip side of that, you've also got when the Federal Reserve is going to raise interest rates, it means that all of the companies that are basically making up the indexes are going to have to pay more for their money that they've been borrowed, which is going to affect their profits. So if they're paying more on the money that they've borrowed, they're going to have to pay more interest on that money, which is actually going to affect their bottom line. So from a technical standpoint, interest rate rises are bad for the stock market, even though it doesn't look like it at the moment.
Unless they get tax cuts.
Unless they get tax cuts. So they're the things that you've got to balance out. You've got to look at it as a bigger picture view, where you're looking at not just one economy versus another. You're basically looking at a basket of what the economy is being driven by, which in the US's case is the top 500 in the S&P and our top 200 in the ASX 200. So that's where we look at the fundamentals. But do we dwell on them? And do they really affect our trading decisions? Not as much as you'd think. Like, we really focus on technical analysis as the primary driver for why we make decisions, and then look at the fundamentals for the very reason that I said. You would expect that as interest rates rise, they will affect companies' profits, which would therefore drop the index. That hasn't happened in the US, and that's the very reason why we don't use fundamental analysis as our primary driver, because if we did, the timing of what happens can often be very misskewed.
Yes. Yeah. So no, agree on that on every area. So it's and with commodities, just quickly, one other thing you said about fundamentals. Look, you're going to see sharp moves off things like nuclear threats that we used to see and used to push oil up and down a hell of a lot. But generally speaking, we look for the technical breaks just like anything else. Just like here on the S&P 500 that I have up, we had massive resistance over here. It breaks to the long side. You've got to have the adequate stop, which will be underneath this pullback here. And it does pull back, scares a lot of retail traders and investors out if they don't have the correct stop, and then goes on to make new highs and goes off into the stratosphere. So as long as you have the right stops and you're looking for technical breaks, generally you have great success.
Perfect, awesome. And just the last question we have here, it's just in regards to these commodities and indices and holding them longer. Now, I understand there's a swap rate involved or a rollover rate. Do you guys take that into account when you're holding these trades, let's just say for, a week, a month, or even longer than that?
Look, it's always very important to consider it. Yeah, Ty, you want to answer it?
Absolutely, it's absolutely important to consider it if you're holding it for a long time. But look, the thing with technical analysis and the way you place trades is that you get a timing window or a horizon, if you like, of how long you expect a trade to take to actually work out. So if you're trading, for instance, a moving average crossover on a daily chart or a weekly chart, say on the S&P 500, you're going to be expecting to hold that trade for probably weeks, if not months. So you are going to have to factor in that there is going to be a swap rate that is going to affect your trade. Now, if you've got a potential, it's more important on the short to be really aware of this. On the long, it's not too bad because you actually get paid the dividend, not the other way around. But on the short, if you were shorting a moving average crossover to the downside, for instance, and you expect it to be in that trade for, let's just say, 2 months, you're going to have to factor in that, yeah, you might be getting a 200-point move, or that's what your expected move is going to be. But 100 points of that might be actually chewed up in what you're paying back as a dividend because you're shorting the market. So it really comes down to your time horizon. If you're only trading over a matter of days or even a week, it doesn't really come into it and we don't factor it in. But when we are looking at our bigger trades where they're going to be in for multiple weeks, we definitely factor in that, because it's almost like, when you buy a house and you're factoring in your repayments, you've got to factor in the interest. And that's effectively what it is.
And no one does that, by the way. So if you use a margin account stocks, if you buy a house, effectively it's a margin loan. When you buy a house, you take a loan and you have to factor that into your real costs. And a lot of people don't do it. So it's very, very important. You just got to calculate it every time.
Good. It's a good question, and it is very, very important that you do if your time horizon is allowing you to go, for longer than a few weeks, because then it can become a little bit painful if you've misjudged it, or you take profit is just simply not going to justify the extra expense that you're going to have to go to get there.
Yeah, awesome.
All right.
I'll just follow up on that quickly because I've just had a few private comments. So if you guys do need help calculating swap rates, just message your account managers and I'm sure they'll be able to give you some worked examples of how to do that and some calculators to help out with that one too.
Yeah, that's excellent, because I know MetaTrader 4 can be a little bit difficult to figure it out. So yeah, if Pepperstone offers it, that would be the best place. Talk to your account manager. That's great. Okay, well, look, that's another week, I guess, of Learn It Live. I'd like to thank everyone for coming out, as always. Next time, I think we're getting a little bit into the charts a little bit more, and not so much about the diversification, but we're talking about some of the stuff in the charts. Thanks, everybody, for coming out, and we look forward to seeing you soon.
Thanks, everybody, and have a great night.
Thanks, guys. Have a good one. Cheers.
See ya.